Welcome back to Vantage. There's a ball behind me in the picture, and it's very appropriate because emerging markets have been booming this year. We're going to talk to a very experienced manager who focuses on an emerging market portfolio. Let's go take a look. Welcome back to Vantage. Emerging markets have been incredibly strong in 2025. We think that's going to continue in 2026. So I'm delighted to be joined by a very experienced manager who manages an emerging market portfolio. Welcome back to Vantage, Charles. For those who don't know you, perhaps you could just outline your role and the fund that you run.
Absolutely. So I head up a investment team based out of Edison. We have offices across the globe, so in Latin America, in Singapore, and we recently have one in Korea. And we're focused on managing a listed investment trust called Utilico Emerging Market Trust. We're listed on the London Stock Exchange, and we had our 20th anniversary this year. And I'm pleased to say that if you looked at the compound total return, it was 5x for the starting shareholders, well ahead of the MSCI index.
Thank you. Well, that's, firstly, congratulations. And it feels like this year, certainly, the spotlight is very much on you and emerging markets. So why should global investors consider an allocation to emerging markets? And what's the right reason behind the strong performance that we've seen this year?
So I think the answer to that is in both pieces. Emerging markets continue to have investable dynamics. So urbanization is still a strong theme. I think people forget that China's urbanization rate is only up to 60%. If it closes in on America, then it needs to get to 80%. If you look at India, it's starting well behind. If you look at, if you want demographics, India and Vietnam, young, aspirant populations. So we've got a lot of drivers that are seeking improved economic outcomes, and those involve, if you want, social infrastructure assets that we focus in on, through to ports and airports that benefit from rising GDP. So I think urbanization, strong GDP growth, and a really good investable background for investors like us who are investing into infrastructure and utilities.
Okay, but some of these themes that you talk about have been around for a while. So I guess the question is, why this year? What's been the sort of catalyst to really sort of generate the interest?
So I think we used the opportunity as the lexicon has shifted to just highlight, if you want, how we approach it. But those trends have been around for the last 20 years. I would say they're going to be around for at least the next 10 years. If you look at the infrastructure spend needed to support, if you want, energy needs, in any one of these markets, it's a huge opportunity because GDP growth needs energy to grow quicker than GDP to deliver it. But when you overlay, AI, data centers, and the shift from an analog economy to a digital economy, the growth demands are enormous. So I think we've tried to articulate the buckets that we believe are going to drive the opportunity. But those underlying fundamental companies are ones that we've been investing now for 20 years.
Okay. And so let's move from emerging markets to why UEM. So what do you offer to investors in terms of capital and income returns? I think you started touching on it, but why the focus on utility and infrastructure assets in particular, rather than all the other sectors, and what are the ideal features of a portfolio company for you?
So why UEM? I think our asset class is unique. Certainly nobody else invests across the emerging markets in the way that we do. And I think our knowledge and understanding of those assets is superior to anything else that anybody can offer. What do those assets offer? They offer a real monopoly or a real barrier to entry, and they offer very strong management teams who are driving them. And you're seeing a compounding effect. So if I looked at something like International Container Terminal, last 5 years, the units, the TUs, the containers grown 5% compound. But if you look at their revenues, because they've obviously been able to price up, their revenues have grown 13%. Their EBITDA has grown 16%. That's a fabulous compounding return. And so what do we offer? We offer a high conviction portfolio that has a lot of resilience in it. Another way of expressing it, low beta, so less than 0.8. But a portfolio that is up and running and operational, generating a cash flow. So 80% of, or over 80% of our investment pay a dividend to us. And that enables us to pay a covered dividend and rising to our shareholders. So I was very pleased that we went into the AIC's dividend hero category this year for our recognition of our compounding revenues. And I think we're the only emerging market trust in that position. So a yield, 3.5%, good performance. This year is 20% total return. And if you were brave enough this time last year and bought UEM shares, because the discount has narrowed, you would have made closer to nearly 40% return.
Wow. Okay. And I mean, I think we touched on it, but why the focus on utility and infrastructure assets rather than, say, a tech company or a healthcare company?
It's where our strength is.
Yeah.
We've got decades of investing in the space across the globe. I think we see the need for infrastructure and utility assets. Governments understand that if you want urban populations demand better sanitization, better transport, better digital infrastructure, and they understand they need external investors, both for capital, but on occasion for expertise as well. And I think that environment gives us a really sound foundation to exploit the opportunity. But we are a focused team who can look at water assets and say, Chile, Santiago, we can compare them to Sao Paulo, we can compare them to Manila Water, the three of which are in our portfolio.
Yeah, okay. And I mean, it's interesting you sort of make this sort of comparison. So what are the things for typically when you find a portfolio company, a company in your portfolio, what are the attributes we should read about?
So I think it goes back to the asset that they are managing, making sure that if you want the regulatory framework is strong, that the ability for them to exercise their management skills across that asset without being disturbed. But then, the strength of the management team in terms of their ability to drive the returns we're looking for. I think if you had to look at, real standout performers, those two features are absolutely key. But I think the third one is almost an expanding marketplace. So if you looked at something, again, like ICT, they are now in 33 ports in 19 countries.
Yeah.
And they're taking the philosophy that they built, developed, understand into each of those new ports and driving the EBITDA margin up to the standards that they expect. And as a result, we've got not only growth because the asset base is expanding, but growth because TUs relative to economy always grows. And if your GDP is 5%, you would expect TUs to be 6%. And they can clearly drive price increases. So it's been a fabulous investment.
Yep. Earlier you touched on, these long-term trends, so urbanisation. I think you've identified 4, effectively, you'll talk about 4. Maybe just identify what those 4 trends are, and then roughly what percentage of the portfolio is allocated to each trend, and maybe just touch on an example that for each trend as well. They're happy to.
So social infrastructure would be things like water, waste, transport, and it's grown this year, partly because we have two fabulous investments in Brazil that have done very well. But it's roughly 37%. Our number one investment in the portfolio is a company called Edison in Brazil. And again, I think one of the strengths we have is this wasn't a big market cap when we went in, but we absolutely bought into the business model, made the investment, and they're now, over $1 billion and growing, and therefore, sizable. But if you want, they spotted the opportunity in Brazil where the Brazilian government had shifted the regulatory framework, so cities could no longer dispose of their waste in the countryside and contaminate the country. They needed to push it through waste treatment sites. They acquired them, improved their practices. Of course, waste every day is coming in, so you've got volumes going up. But they put in recycling, they put in collecting methane, selling it back to the grid, and obviously a lot of green certificates that they have because of the activities that they're improving. So, Edison, an extraordinary story. And I still think a long way to go. But it's not going to be buffeted by GDP growth or wider economic outcomes. And the government is determined to see in Brazil a cleanup of the environment. So I think we're all aligned, and I think the opportunity is significant. If you looked at energy, there is clearly a shift to renewables, no different than the developed world. But there's also just a raw need for more power, more transmission. And I call them my forever stock. There's a company again in Brazil called Allocation. Family-run business. They have 9,000 kilometers transmission lines. They keep adding to, if you want, the assets that they run. They're very disciplined, and they're able to achieve savings on building out the infrastructure. They usually bring it on earlier and therefore benefit more from the concessions that they've got. And they've been compounding EBITDA at around 16-17%. So, and I can see it continuing because there's constant auction of new transmission lines which are needed. But a lot of things that are driving that sector, I think, are around the need for energy, clearly data centers, and the whole digital economy. But I also think energy security. The countries are suddenly woken up, and where am I getting my energy from? And therefore, there's a lot of concerted effort to enabling investment to happen. If I look at digital, I think everybody understands the shift from analog to digital. I think, for me, I was amazed at the impact of COVID and the lockdown drove everybody online. And somewhat, the emerging markets have always been able to skip some of the investments that we've needed to make as we've emerged through technologies in the developed world. But they've adopted it 100%. And you can see the growth in terms of data centers. And that demand, we believe, will continue and probably accelerate. At some point, governments are going to come out with digital tokens in terms of coins. They're going to come out with infrastructure that's much more digitized than it is today. So very excited about that opportunity. We've got an investment in Korea in a data center really well located, and it should be able to compound growth going forward. The third one is transport, and if you want, trade. And I think when Trump came in, everybody got anxious about global trade. I think my view was business will sort out, if you want, supply chains and respond. When Trump came in this time, I know that everybody was anxious. Again, my view was that business and governments have sought out supply chains, and they've done exactly that. Yeah. So, yes, it might be difficult, but China in the month of October just had $1 billion of trade. It was astonishing, and it's encouraging because you can see that the ports and assets out there will continue to thrive and grow. So I'm excited about it. In terms of allocation, social infrastructure, 37%, it's up because a number of investments 2 years ago, 3 years ago that have really grown in value. The digital infrastructure, 25%, energy transmission, 25%. Yeah. Ports, 15%, but just down. Okay. But it's down because 2 ports within our portfolio were bid for earlier this year and taken over. Santos in Brazil, fabulous port. We sold into the offer, and Ocean Wilson again have a port in Brazil. They've sold their port, had a tender. We tendered everything and then sold balance. So we're out on those 2 ports. It's not a statement on, if you want, or a concern about global trade. I think global trade go on and thrive.
Okay. You touched, I think when you talked about the sort of 20-year anniversary, you talked about some of the performance, and particularly against MSCI emerging markets as a sort of reference point. Have you done, so let's performance-wise, let's talk about this year, but also a longer-term trend. What is the absolute and relative performance? What do you want to sort of highlight to people?
The absolute relative performance over that 20 years was about 150% ahead of the MSCI. I think one thing I do want to properly stress is we reference the MSCI because the market wants us to reference something. Yeah, it's not a index that we come in and even remotely focus on. If you looked at the constituents of our portfolio, it is just diametric to the MSCI index. We're not in TMSC, we're not in a whole bunch of companies, Samsung, all of which are driving the MSCI at the moment. And it's irrelevant to our performance. I want to achieve a total absolute return. I'm a shareholder. Yeah. So I'm focused on outcomes, if you want. But we've beaten the index over since inception. If you looked this year, I think year to date, we're up 20%. I think the index is up 24%, a little bit because of all of the, if you want, interest around DeepSeek, those things. My experience is it'll flow through to demand on data center. It'll flow through to demand in logistics and pitch up in our portfolio.
Yeah. Okay. I love the experience that you bring, Charles, and it's something where I think people, you share your wisdom very sort of openly. As we're sitting here, in December, looking forward to 2026, how are you thinking about 2026 and what's the sort of current investment backdrop that you're also taking into account?
So I think I'm excited about 2026. I think the US is probably going to pursue a policy of lowering interest rates, softening the dollar. Commodities are likely to rise. If you look at Latin America, they're a commodity play. Brazil is all about soft and hard commodities. So rising commodity prices should be good for them. Latin America, lower interest rates in the US will enable central banks to continue to lower local interest rates. A lot of investors still are in fixed income. And as interest rates come down, they'll look for equity investments. So I'm optimistic on a sort of valuation basis. I'm optimistic that, our portfolio is cheaper than the emerging markets. If you looked at If you want price earnings ratios, we're about 10% cheaper. But the whole emerging market is still cheaper. And therefore, it's a destination for investors. And I think as investors seek to invest away from US and exceptionalism, they'll find their way to the emerging markets.
Yeah, no, I can see that. And I think it will remain a trend for the years to come. Charles, thank you so much for coming back on the show. Congratulations on the 20-year anniversary, a remarkable milestone. Great to hear about the performance, and we look forward to tracking how you do in 2026.
Well, you'll be able to do that. We've also gone into the FTSE 250, so I think it will be more visible to more shareholders.
Yeah, great. Thank you.
Thank you very much.